So we completed the chapter capital budgeting in the previous class. We started with the chapter options. I have to give you the Hiller's model notes for the capital budgeting and the solution for 1 or 2 homework sums. As I said, give me some time because when the IPCC batch gets completed, I'll be having time to key in and give it to you. Okay. Surely it will be given. I have to give the notes for Hiller's model and then the solution for some unsolved capital budgeting sums. Please. We started with the chapter options in the last class. We had a fairly elaborate introduction to the options chapter and did also 3 basic sums. In today's class, we'll complete the remaining 4 problems in the basics in option 5, 6, 7 or 5, 6, 4, 5, 6 and 7. Once we complete the 4 sums, we'll also do another simple, very basic area called as option strategies. Okay. Once we complete the option strategy only, the real chapter takes off with the option valuation concepts. From there, the chapter becomes very in-depth as well as interesting also. Till then, we'll be getting used to the various calculations. That's it. Okay. Now, today's class will be fairly easy as well as simple only. We'll be completing the remaining problems in basics in options and then trying to complete as much as possible in the option strategies. Now, I hope you all have gone through the introduction which has been discussed in the previous class. Derivative segment alone, be on par with me. Make it a point that every day you revise and come to the next day's class so that flow will be there. I'll tell you the problem in these chapters is throughout the option chapter, I'll only speak maximum 4 or 5 words. Call option, put option, exercise, lapse, FSP, strike price, term. Apart from this, no more extra words will be spoken. You become immune to it unless you go for the revision very consistently. That's why I said revise it. I cannot afford to go at the same speed how I did the previous class. At some point of time, momentum has to be increased, where the routine calculation should be done very fast. That's why I said revise regularly the options chapter before you come to the next class. Okay. Now, let us summarize what is done in this option till now before I proceed doing some more problems in the basics in options. See, we saw that option is a contract. It's a contract between 2 parties, holder and then writer. The option can be classified into 2 types, call option and then put option. Call option gives the holder the right to buy an underlying asset on maturity date at an agreed price called as strike price. And the writer of the call option is having an obligation to sell if the holder exercises his right. Put option holder gets the right to sell an underlying asset on the maturity date at an agreed price or strike price, and the writer of the put option is having an obligation to buy if the holder of the put option exercises his right. This is the 2 types of option, the call option and then put option. Now, Mr. A is having a right to buy share of X Limited at 100 rupees after 3 months. And B has given that particular right. Please tell me who is Mr. A? Holder. Who is Mr. B? What is the share of X Limited called? Underlying asset. What is the 100 rupees agreed price called? Strike price. What is the 3 months called? The maturity date. And holder is purchasing what? Purchasing the right to buy the share. He is purchasing an option. For purchasing the option, holder has to pay premium. Now, the strike price is 100, call option. or after 3 months on the maturity, suppose the share is trading at 110 rupees, will the holder exercise or lapse or exercise? Because he has a right to buy at 100, a share worth 110. If the share is trading on the maturity at 90 rupees, what he will do? Lapse. Now he has a right to buy at 900, a share worth 90. Now the price of the share can be of 3 types. What 3 types of price are? Spot price, strike price and future spot price. Spot price is the price at which the share is trading today. Strike price is the agreed price for tomorrow's transaction today itself. And what is the future spot price? Actual price prevailing in the market on the maturity date of the option. Now, A gets a right to sell a share of X Limited at 100 rupees after 3 months. And B is giving that right. Once again, don't get irritated. Tell me who is A? Holder. Who is B? Share of X Limited. Underlying asset. 100 rupees. Strike price or exercise price. And what is 3 months? The maturity period. And A purchases right. What right? Right to sell. That right to sell is called as put option. And when the share price is suppose 110, exercise or lapse or lapse. He has a right to sell at 100. A share what? 110. If the FSP is 90, exercise or lapse or exercise, right to sell at 100. A share what? 90. Now tell me, holder of a call option is having a right to buy, right of a call option is having a obligation to sell. Holder of a put option is having a right to sell and writer is having an obligation to buy. Call option holder is generally bullish. He expects increase in price, hence go for agreed purchase price. Holder of a put option is bearish. He expects a decrease in price and hence go for a guaranteed selling price. It is opposite for the writer of a call option as well as the writer of the put option. And this option can be classified into 2 types, European option, American option. European option can be exercised only on the maturity date. American option can be exercised anytime during the maturity. I think these are all the issues we discuss in the options. Nothing but introduction has been made, basic issues are being discussed. Everybody, can I proceed or not? No. Don't be in a hurry to learn. We'll be learning so many things as we go deep into the chapters. Whatever doubts about premium, anything you have, keep it in pending. Nothing will be left uncovered. Very deep. I think entire hull will be discussing in the class itself. No concept will be left uncovered in our options. Okay, can I proceed or not? Now, take question number 4. Take question number 4. Now, please settle down quickly. Please fast. Take question number 4, please. Consider, please. Consider the following information. Future spot price 50 to 90 with an interval of rupees 5. Strike price 70, premium rupees 5 paid on call option. Find out the payoff for the holder of call option. Find out the payoff for the writer of call option. Right? Ignore time value of money. We'll bring the time value of money into the picture later. Okay? Ignore time value of money. This I need not dictate every problem. It is common for all the sums I want to do today. Ignore what? Time value of money. Okay? Now, tell me, the option discussed here is call option or put option. Everybody, call option. What is the strike price of the call option? 70. What is the meaning of this 70? The holder of the call has a right to buy the share at how much rupees? 70 if he wants. Are you following or not? Now, for getting this right, what is the premium that is paid by the holder? 5 rupees. This 5 rupees is income or expense for the holder, expense. For the writer, it is what? Income. And future spot price, that is on the maturity date, the share price can be 50 or 55, 60, up to 90 for the various FSPs. They ask you to answer the question. Okay, from 50 to 90 in the intervals of 5, we should be answering the question. Can I proceed or not? Now, tell me, what is the meaning of value? Normally, what is the value? Benefit. If you get a benefit from me, I am valuable to you. Yes or no? Another share value, present value, future benefits. Yes or no? The word value means what? Benefit. Net present value means what? Excess of benefit over cost. Everybody yes or no? So the word value means benefit what we derive. We call as what? Value. Can I proceed further or not? Now, let's start doing the sum together. No rocket science. Very simple type. Like that number of times question has been asked in the exams. These are all simple basic level problems. Can we start or not? Now. Okay. Please open the following columns. FSP means future spot price. VC means value of call. VC means what? Value of call. Exam don't write the abbreviation, write the full name. Value of call, premium, payoff of holder and payoff of writer. Please. The word payoff means how much a net earned after meeting their expenses. Payoff of holder, payoff of writer. Please stop talking. Shall we start doing it together or not? Now, everybody. First, one by one. First FSP is what? 50. Let's start doing 50. We have to participate, understand as well as write. Okay. Now, FSP is 50. You are a call option holder. I am the writer. Understand like that? Now, FSP is 50. The strike price is what? 70. On the maturity date, the share is trading at 50. You have a right to buy at what? 70. Will you exercise the right or will not exercise the? Will be lapsing it. So the call is what? How much? 0. It is worthless for you because the option did not give you any benefit. It's all no. Rumba simple, yeah? Examination, they give choice, the option, right or not? They give you question 1A or 1B choice here. Both answer you don't know. What is the worth of the option? Nil. Yes or no? Even giving choice is worthless because you are not prepared. Enough for right or not? Now, option is what? Only when it is going to be what? An exam. Only when it is going to be exercised. Right or not? Now, what is the value of that call? 0. The call has become worthless. I paid some premium, bought the call, no. It did not give me any benefit. It has become what? Worthless for me. The value it gave me is 0. Everybody, yes or no? Now, next is, premium is how much rupees? 5 rupees. Now, for holder, this 5 is plus 5 or minus 5 or minus 5. He pays. So the call value is 0. The premium is what? Minus 5. What is his net profit or net payoff? Minus 5. Holder payoff is minus 5. Writer very happy because option is what? Lapsed. He pocketed the entire premium. Don't say return the premium and did not exercise the option. Not so. Option is given only as an insurance. So you may die, you may live. They'll take the premium. Yes or no? No. In that case, the payoff of writer is plus 5. He earns the premium. Please. He earns the premium 5 rupees. Don't talk. No. All of you involved 55 rupees. Strike price 70. Will you exercise? Will not exercise? No, will be lapsing it. What is the call value for you? 0. The options become worthless for you. For a worthless option, you paid how much rupees? 5 rupees. What is the loss for you? 5. What the writer's gain? 5. He pocketed the premium, you lost the premium. Can I proceed or not? Next, 60 rupees. FSP is 60. Tell me, will you exercise a lapse or lapse? When you lapse, what is the value of the call for you? 0. What is the premium? 5. The premium you lost, how much rupees? 5. What is the gain made by the writer? 5 rupees. Respond yes or no? No. 65. A share what 65? Will you buy at 70? No. Will you exercise or lap some? Laps. What is the worth of the call for you? 0. For a call worth 0, you paid how much rupees? 5 rupees. Or the loss for you? 5. What is the gain for the writer? It is 5 rupees. 70 rupees. You have a share worth 70 to buy at 70. Exercise or labs are indifferent. Whether you exercise or labs, I purchase at 70, a share worth what? 70. Still call is not beneficial for me. Yes or no? No. In that case, what is it here? 0. The value of the call is 0. What the premium you paid for a worthless call? 5 rupees. How much you lost? 5. What the writer gained here? 5 rupees. Till now I am very happy. Yes or no? Why I am very happy? I am the writer. You are what? A holder. You are very angry with me. Written or? No. Don't worry. Let us continue further. Please reply. You write in the same sheet. Can I proceed? Now. FSB is what? 75. All of you, will you exercise or not? Yes. You have a right to buy at 70. A share what? 75. What is the value of the call? 5. By call holding, you have gained 5 rupees because a 75 rupees share due to call only. You are able to buy at what? 70. The call is worth how much for you? 5 rupees. How much you paid? 5 rupees. What you net gain? 0. Now for the writer, what happens is, he has to sell at how much rupees? 70, a share what? 75. He has to sell at 70, a share what? 75. He is suffering a loss of how much? 5 rupees. He earned how much premium? 5 rupees. What writer pay off? 0. No. Exactly. Can I proceed? No. 80. At 80, will you exercise or labs or exercise? Why will you exercise? Tell me. You have a right to buy at 70. You share what? 80. You'll exercise means how much you gain? 10 rupees. For a call worth 10 rupees, how much you paid as premium? 5 rupees. What the net payoff? 5 rupees. As a writer for me, I'll be laughing and crying. I have to sell to you a share worth 80. For how much rupees? 70. What the loss for me? 10 rupees. How much I earned as premium? 5 rupees. Then payoff is minus 5. Now, don't be lazy in again telling that reinforces and gains you speed later. Can I say? No. At 85, tell me I will exercise the labs or exercise. I have a right to buy at 70. Yes, I worth what? 85. Hold the exercises makes how much gain? 15. The call is worth how much? 15. For which he paid how much? 5 rupees premium. Then gain is 10. Writer will be crying because you have to sell at 70, a share what? 85. 15 rupees loss. He made how much premium? 5 rupees. What the payoff at is? Minus 10. Ennappa writer not? No. Next is what? 90 rupees. What is the value of the call? 20. What is the premium? 5. What is the payoff of the holder? 15. What is the payoff of the writer? Minus 15. This is how we have to calculate the payoff of the holder and then writer of a call option. Please respond everybody. Are you understanding it or not? Is the speed okay? Are you comfortable or not? No. So, this is regarding the payoff of the holder and writer of a call option. Okay, now let us put this in form of a small diagrammatic representation to generalize our discussion and discuss a concept called as break-even FSP and then go to the next problem. Can I proceed or not? No. Scale good. Say, What you have mastered? You mastered ragging, okay? See. Now, this is future spot price. And we have payoff here, okay? Please. This is -5, 0, and then +5, please. And this future spot price is, I think, break-even FSP is 75. This future spot price is 75. Now, see, if you just look at a notebook, we have holder as well as what? Writer. They are having the payoffs. It or not? No. And this place, we can call it as 70. We call it as what? 70. That's going to be the strike price. It or not? No. See, this is the payoff of a holder, and this is the payoff of a writer. Okay. A holder payoff and then a writer payoff. Let's take the holder. Holder will have 0 payoff when the share price is how much rupees? 75. At 75, the value of the option just recovers the premium. The payoff is 0. Below 75, it will be having a negative payoff. After 75 is having what? Positive payoff. That's point number 1. Are you following or not? No. And his maximum loss will be restricted to premium only. Okay. He cannot have -6 as a loss. The loss maximum is only what? Premium. Because if the situation is unfavorable, he will allow the option to what? Lapse. What he loses ultimately maximum is what? The premium which he pay for the option. So his maximum loss is what? The premium. So below 70 the entire premium is lost, and slowly the premium is recovered after what? 70. Suppose 71 call value is what? 1, and out of 5 rupees 1 rupee premium recovered, and the loss becomes what? 4. The loss becomes what? 3. The loss becomes 2, 1, and becomes 0 at what? 75, because 5 rupees value recovered the full premium. Beyond that, he'll be earning profit or the positive payoff. Respond yes or no. Either the payoff of the holder of a call option. Please respond yes or no. No. Go to the writer of the call option. For the writer of the call option, his maximum payoff premium. The maximum payoff is what? Premium. What he can enjoy maximum is what? Premium. But his loss can be unlimited. Holder's profit can be unlimited. Holder's payoff can be what? Unlimited. Share price 200. Or share price how much here? 200. Right to buy at what? 70. He makes what? 130 call value. 5 rupees premium. Payoff can be 125. Yes or no? Share value 1 crore. For example, okay. It can become what? Unlimited. So the payoff of the holder is unlimited. Like that, the loss of a writer is unlimited. Yes or no? What profit the holder makes, the loss is going to be the writer. Yes or no? The loss of the writer is unlimited, but the income you can earn is what? Limited. It's only how much rupees premium? 5 rupees premium. Yes or no? Now, from this, let us take one by one. At 70 rupees, the FSP is equal to what? Strike price. Yes or no? Now, after 71, tell me, after 71, call begins to give value. After 70, the call begins to give what? Value. That value fully recovers a premium at what? 75. Beyond that, the call gives profit to the holder and loss to the writer. Everybody, yes or no? So below 75, writer makes a profit. Above 75, holder makes a profit. In the right or not? And the writer profit is maximum what? 5. And the holder profit is unlimited. And the writer loss is what? Unlimited. And the holder's maximum loss is what? Premium only. Is a feature of a call option for the holder and writer. I want you to observe properly. Everybody, yes or no? Can I proceed further? Now, I'll complete my discussion and then I'll give you time to copy the diagram and few more calculations. Can I start or not? Now, I put a question. I'll first make the sentence and then put a question. Holder of a call option is having a ability to earn unlimited profit. True or false? True or false? True. A holder of a call option can earn unlimited profit. His loss is unlimited. True or false? False. The maximum loss is supposed only what? Premium paid. In number right or not? Now, come to the writer. Writer of a call option is having an ability to earn unlimited profit. True or false? False. His maximum profit is only what? Premium earned. But his loss is limited or unlimited or unlimited. You understand about these two persons or not? I'll put a question now. You like to be a holder or writer? Question, you like to be what? A holder or writer? So, if everybody wants to be the holder, who will be the writer? Yeah, I am here, okay, I know, but still. Can I proceed? A point to think, right or not? Because holder is having an unlimited profit, but loss is limited only to premium. But writer is having what? Unlimited loss ability, but his profit is limited only to what? Premium. In that case, questioner is as everybody likes to be only holder. Naturally is seeming to be having an advantage. Yes or no? And who will like to be writer? Question asked. In a question, will anybody be going for a writing of an option? Question arises, no. Now, I'll tell you, please. See, this premium will be fixed in such a way that at the inception of the option, holder and writer will be equally placed. Remember, all derivatives, options, swaps, etc. If the holder has a chance to make great profit because of the share price movement, the writer will charge high premium. Remember, he'll charge what? A high premium. Very simple. See, a share price, suppose 70 strike price. Now, strike price is what? 70. This company's share price doesn't fluctuate very much. Doesn't fluctuate what? Very much. It is always going in the range of 60 to 75 or 80. Okay. In that case, the share price volatility or the variance is what? Very less. It's not a volatile stock, almost a steady stock. Yes or no? In that case, you are not covering a great risk. You are not covering what? A great risk. You are giving an insurance for almost a steady stock. I'll find out what I'm saying. In that case, the writer will charge what? A lesser premium. Yes or no? Suppose there's a share which price jumps up and down very much. You can touch 250, can even drop to what? 70, or can even drop to what? 30, can even touch 300, like that. The share price goes very much up and down. The share price is very risky. Yes or no? The down drop, holder will not be worried because he can lapse it, yes or no? He can touch up to 250, 300, then the writer says, look at the share price, it's a very volatile stock. I'm covering you this volatile stock for strike price of 70 or not. I'll fix you what? High premium, yes or no? The premium compensates for what? Risk. That means the entire success of option depends on how you calculate the premium, yes or no? Adamba chapter 8. After today's class or another 1 hour in next class, the entire remaining chapter will be discussing about what? How to fix the option premium. Everybody yes or no? So many great models like Black-Scholes, risk neutralization, everything is going to come. So the entire chapter hinges upon what? How the premium should be calculated. Same way, insurance companies fix premium or not. Not such an easy issue. It involves what? So much actuarials or what? Mathematical calculations, the age of the person, the disease he may be suffering, all those things, because he is covering a risk, yes or no? A 90-year-old person will not allowed to take life insurance. Still he takes life insurance, the premium will be equal to sum assured, yes or no? Because he is going to be paid the entire amount, right or not? In that case, age is a factor or not? Like age, you have what? The volatility of the share price. Everybody found out what I am saying? So, how much guaranteed strike price you are giving, what is the volatility, all goes into account while fixing the premium. Don't worry, holder, writer, both are equally placed at the time of signing the agreement. Otherwise, nobody will enter into a contract where one party will be under disadvantage. Both should believe that we are at one advantage. Then only a transaction is a fair transaction. Are you following what I am saying? In that case, the entire success of option contract depends on how good you calculate the premium. Above that only, in the future classes, we will be discussing elaborately with lot of mathematical calculations. Everybody following or not? So, tell me, you like to be a holder or writer? You can be anybody. Holder is having an unlimited advantage. For that is paying a price called as what? Premium. Writer is having what? Disadvantage. For which he receives a compensation called as what? Premium. If such premium is what? Properly fixed at the initiation. Later, all of predictions only know. Later, one may be proved right, another may be proved what? Wrong. It happens in any transaction, but at least at the time of what? Initiation, they will be equally placed or what? Fairly placed is what I wanted to communicate. Everybody, are you following or not? Clarity? So this is regarding the holder and writer. One more point I will discuss, and then I'll give you the time to copy this diagram as well as some notes in this regard. Can I proceed? Now, see. At 75, what is the payoff for the holder? 0. What is the payoff of the writer here? 0. 0 is called as break-even point. Now, this is FSP, this 75 rupees I call as break-even FSP. I call as what? Break-even FSP. Break-even future spot price. At break-even future spot price, what happens here? The option value recovers the entire premium, giving 0 payoff for the holder and 0 payoff for what? The writer. What is break-even point? Contribution is equal to what? Fixed cost. What is break-even FSP? The premium is equal to what? The value of the call option, or the payoff is 0. Everybody following what I am saying? Now, very simple. What is break-even FSP? The formula is break-even FSP is equal to strike price plus premium. What is break-even FSP? Strike price plus premium. What is strike price? 70. What is premium? 75. What is premium? 5. What is break-even FSP? 75. Respond. Are you following what I am saying? Tell me, what is the formula for break-even future spot price? Strike price plus premium. I am not considering time value of money. Reason is, the strike price is payable after the maturity period. So no. Premium is paid what? Today itself on the option entering. So both are having different time value of money. That's why I said all our discussion now we are making without considering what? Time value of money. We'll bring that into picture later, because here there's a special technique called as continuous compounding to be followed. Can I proceed or not? Now, so now did you understand this concept or not? Tell me the formula. Break-even FSP is equal to what? Strike price plus premium. Okay. Now, at break-even FSP, what is the payoff of the holder? What is the payoff of the writer? Okay. If the FSP more than break-even FSP, answer, FSP more than break-even FSP, who makes profit? Holder. Who makes loss? Writer. If the FSP is less than break-even FSP, who makes profit? Writer. Who makes loss? Holder. Holder's maximum loss? Premium. Writer's maximum gain? Premium. Holder's maximum gain? Unlimited. Writer's maximum loss? Unlimited. Is what I have to understand by nature of the call option. Everybody understanding it or not? Can I proceed further? Write down. Just copy the diagram. Please copy this diagram quickly. Stop talking, please. Finish drawing the diagram or not? You need not copy this, draw only the diagram. Nothing there to draw here. I have drawn in 1 minute. You will see or not? No. If you put like this, 75, 70, that's all. Yeah. What are you doing here? Are you drawing Ravi Verma art? Or small 3 lines you have drawn. Can I proceed? No. Rubber put sketch pen, pencil, rubber. Lab note money agita. Can I proceed? Now, please. Shh. Finish drawing or not? Now, please. Can I proceed? Write down. Notes. Write down notes. Point number 1. Point number 1. The FSP at which, point number 1, the FSP at which, FSP means what? Future spot price. The FSP at which the payoff to the holder and writer is 0. The FSP at which the payoff to the holder and writer is 0. The FSP at which the payoff to the holder and writer is 0 is called. The FSP at which the payoff to the holder and writer is 0 is called what? Break-even FSP. Is called break-even FSP. Is called break-even FSP. Point number 2. Break-even FSP is equal to, point number 2, break-even FSP is equal to strike price plus premium. Break-even FSP is equal to strike price plus premium. X is a very much accepted notation for strike price. Okay, break-even FSP is equal to strike price plus premium, which is equal to 70 plus 5. Which is equal to 70 plus 5 is equal to 75. Is equal to 75. Point number 2 or 3 are 3. In center right situations. In center right situations, branch it into 3. Situations, branch it into 3. First branch, FSP less than break-even FSP. First branch, FSP less than break-even FSP. Second branch is FSP is equal to break-even FSP. Third branch, FSP greater than break-even FSP. FSP greater than break-even FSP. So branch it into 3. Can I proceed or not? Now, write one bit another. First branch, put that down your mark and write. Tell me, FSP less than break-even FSP means who is earning profit, who is earning a loss. Writer has profit, writer has profit, and holder has loss. Writer has profit and holder has loss. Writer has profit and holder has loss. Again put the number and write the maximum profit to the writer, the maximum profit to the writer, the maximum profit to the writer and loss to the holder is, the maximum profit to the writer and loss to the holder is, tell me how many days here? Premium. The maximum profit to the writer and loss to the holder is premium. Go to the second branch. FSP is equal to what? Break-even FSP, right? Both has 0 payoff. FSP is equal to break-even FSP. Both has 0 payoff. Both has 0 payoff. FSP greater than break-even FSP. Who makes profit? Holder has profit. Or holder makes profit. And writer has loss. Holder makes profit and writer has loss. Holder makes profit and writer has loss. Again put the down mark and write holder's profit is. Holder profit is unlimited. Holder profit is unlimited and writer's loss is unlimited. Holder's profit is unlimited and writer's loss is unlimited. And writer's loss is unlimited. I hope everybody understanding it or not. Last point. Point number 4. Point number 4. Prima facie, it seems that the holder is at an advantage. Prima facie, it seems that the holder is at advantage. Prima facie, it seems that the holder is at advantage in the option contract. The holder is at advantage in the option contract. I need not say why. Why the holder is advantage? Yeah, unlimited profit, limited loss. Obviously, no, the holder is an advantage in the option contract. However, the disadvantage suffered by the writer, will be adequately compensated by the disadvantage suffered by the writer will be adequately compensated by what? Appropriate premium. Will be adequately compensated by an appropriate premium. Will be adequately compensated by an appropriate premium. Continue. Full stop. If the chance of writer suffering a big loss exists, due to the nature of share price movement, obviously, he will charge what? More premium. Just an example I said, not so simple. Premium is dependent on so many factors. Okay. Obviously, he will charge more premium. Everybody, yes or no? No. Last point. Point number 4 or 5? 5. How an appropriate premium should be calculated? How the appropriate premium should be calculated will be the major discussion in this chapter. How an appropriate premium should be calculated will be the major discussion in this chapter. Everybody, are you following or not? Really, the chapter starts only when you start discussing about the premium valuation. Can you proceed or not? No. With this, we complete the solution to question number 4. Am I right or not? Can you proceed? No. Take question number 5. Please take question number 5. Very similar to 4, but for what? A put option. Take question number 5. Please. Stop talking. Settle down. Consider the following information. No need to turn any page. This is the same page 81. Get up. Why I am hearing page noises? No need to write the notebook also. I have not started writing. Yes or no? Now, full silence here. Consider the following information. Future spot price 50 to 25 with an interval of 5. Strike price is 30. Premium 2 received on a put option. Find out the payoff of the holder of put option and find out the payoff of the writer of put option is the question that is being asked. Okay. Now, tell me, what is the strike price? What strike price? 30 rupees. Holder is having a right to sell at how much rupees? 30 rupees. To get this right, holder pays how much premium? 2 rupees. And the FSPs can be ranging anywhere between what? 25 to 50 with the interval of 5. So they ask you to do in like the same, like a last problem, the put option, pay off for the holder and then writer. Can we proceed or not? Now, let's start doing the solution together. Write down question number 5. Please. Same columns except VC, we write what? VP. The value of put option. How much the put option is what to the holder. Except VC write as what? VP. Please. Shh. Okay. When will you exercise a put option? When FSP is less, FSP is more. FSP is what? Less. When FSP is less than strike price, I have to exercise what? Put option. Can I start or not? No. FSP 25. Have you finished opening the columns or not? Can I start? FSP 25. I have a right to sell at 30. A share worth how much? 25. Will I exercise the right? Lapse of exercise. I will sell at 30. A share worth what? 25. What is the worth of the put for me? 5 rupees. I get 5 rupees from the put. For getting this 5 rupees value, I had already paid a premium of how much rupees here? 2 rupees. Now tell me, for the holder, he makes a profit of 3. Think about the writer. Writer is buying at how much rupees? 30 rupees. A share worth only 25. Writer suffers how much loss? 5 rupees. He receives how much premium? 2 rupees. What the net loss happened by him? 3 rupees. Minus 3. Everybody understood or not? No. Please. 30. I have a right to sell at 30. A share worth what? 30. Exercise and labs are indifferent. Anyhow, whether I exercise or not, the put is going to be what? Worthless for me. 0. Put is worthless. For a worthless put, I paid how much premium? 2 rupees. For the payoff of the holder, minus 2. Writer is what? Writer is plus 2. Now, anything above 30, always the pay of a holder is what? Minus 2 and writer is plus 2. Accept or not? One more time I will do it. 35. 35. Will you exercise a put or lapse? Lapse. Put is worth what? 0. For which you paid how much? 2 rupees. What the loss suffered by the holder? Minus 2. Writer takes the entire premium home plus 2. Like this, you can just copy the remaining slide quickly. Please copy this quickly. Please stop talking. Finish copying up. Please. Finish copying or not? No. Same way, we are going to write the payoff of the holder and writer of a put option. Please, all of you, don't talk. X-axis is what? FSP and Y-axis is payoff. FSP and then payoff. Please, copy along with me. Draw this diagram quickly. Please. I'll put the number along with you, okay? FSP and then payoff. Finish copying. Can I proceed or not? No. See. What's happening? Those who are not copying, raise your hand. Draw a y-axis, x-axis, one line like this, one line like this. That's all here. Please. Okay. Can I proceed? This is plus 2 and this will be minus 2. This point is what? Minus 2. Payoff can be plus 2 as well as what? Minus 2. Please. Now, I want you to answer. There is a line at the top, there is a line at the bottom, right or not? Now, you should tell me who is the holder, who is the writer. This line, look at my pen. This is a holder liner, writer liner, holder, writer. Correct, Yosulapa. Don't put a task. It's going to be what? Holder. I'll explain after I write it. There will be a line of what? Holder. This is the payoff of what? Writer. Payoff of writer. Very simple. Holder's maximum loss is what? Premium. And the writer maximum gain is what? Premium. Innappa right or not? No. See. This intersection point in x-axis is called as what? Break-even FSP. It is called as what? Break-even FSP. Now, stop writing and tell me what is break-even FSP for call option? Strike price plus premium. For put option, the break-even FSP is equal to strike price minus premium. What is the strike price in this case? 30. What a premium? 2 is equal to what? 28. This number is how much here? 28. At 28, the writer and holder both will be having what? 0 payoff. This we call as break-even FSP. Yes or no? Now, where it begins to take a turn, we want the 30 rupees. It is 30 rupees is the strike price and the FSP, it is 30 rupees. Please. Now, let me explain once again. Listen before I go further. Notes in this regard. No need to copy the break-even FSP. Now, please. Listen here. When the FSP is more than strike price, understand that when the FSP is what? More than strike price, will the option be exercised or lapsed or lapsed? When the option is lapsed, the writer pockets the entire 2 rupees premium. Yes or no? When the option is lapsed, the holder suffers what? 2 rupees as loss always. Innappa right or not? So, the writer earns a premium of 2 rupees. The holder what? Loses the premium of 2 rupees. When the FSP crosses what? A strike price of 30 rupees. Understanding it or not? No. When the FSP is less than 30, then the put will be exercised. Yes or no? Now, suppose it is 29. Suppose it is what? 29. Exercise or lapse are exercise. I have a right to sell at 30. A share worth what? 29. How much value put gives me? 1 rupee. I get 1 rupee, but paid a premium of what? Minus 2. My loss from minus 2 becomes what? Minus 1. Ennappa right or not? No. When the FSP becomes what? 28. My loss is what? 0. Then I begin to make a gain. He begins to make what? A loss. He is what is the payoff of the holder and writer of put option. Ennappa right or not? Can I proceed further? Write down notes. Write down notes. Okay, write down. Point number 1. The break-even FSP for a put option is, point number 1, the break-even FSP for a put option is, the break-even FSP for a put option is strike price minus premium. The break-even FSP for a put option is strike price minus premium. For a put option is strike price minus premium. Can I proceed? Which is equal to, tell me what is strike price? 30 minus 2. 30 minus 2 is equal to 28. Is equal to 28. Can I proceed or not? Now, next. Point number 1 or 2? 2. Situations. Point number 2, right? Situations. Branch it into 3. Situation. Branch it into 3. Right, as I dictate. First branch, FSP greater than break-even FSP. First branch, FSP greater than break-even FSP. What is second branch? FSP is equal to break-even FSP. Second branch, FSP is equal to break-even FSP. Third branch is what? FSP less than break-even FSP. FSP less than break-even FSP. Future spot price less than break-even FSP. Can I proceed or not? Now, go to the first branch, put a down arrow mark and write. Answer me. When the FSP is more than break-even FSP, tell me what happens. The holder makes loss, writer makes profit. Write down. Holder makes loss. Put the down arrow mark and write. Or you're understanding and writing it or not. Very simple issue, but concentration required. Holder makes loss and writer makes profit. Holder makes loss and writer makes profit. Again put the down and write the maximum loss to the holder. The maximum loss to the holder and profit to the writer is. The maximum loss to the holder and profit to the writer is. And profit to the writer is what? Premium. The maximum loss to the holder and profit to the writer is premium. And profit to the writer is premium. Etc. or not? Now, go to the next. FSP is equal to what? Break-even FSP. Tell me what is that here? Payoff is 0. Payoff is 0 for the holder and writer. Payoff is 0 for the holder and writer. Payoff is 0 for the holder and writer. Can I proceed? Now, go to the third. FSP less than break-even FSP. Who makes profit? Holder. Write down. Holder makes profit. Third branch, put the down arrow and write. Holder makes profit and writer incurs loss. Holder makes profit and the writer incurs loss. Holder makes profit and the writer incurs loss. Now, again put the down arrow and write. Don't write first, let us discuss and then write. Profit to the holder is limited or unlimited? Profit to the holder is limited or unlimited? Profit, loss to the writer is limited or unlimited? Now, it is limited only. Unlike call option, holder cannot earn what? Unlimited profit. Unlike call option, writer will not have what? Unlimited loss. The reason is very simple. 70 rupees last problem strike price. The stamp price even go up to 1000 rupees. Possible or not? Yes. But in case of put option, holder makes a profit not when the share price rises, he makes profit. The share price what? Decreases. Can share price become minus infinity? Yeah? It can be dropping maximum to what? 0. A share cannot trade at negative price in the market. Yes or no? Correct? Now, in that case, maximum you can have a value is strike price. 30 rupees strike price. A share is trading at what? 0 rupees. You can make how much value? 30 rupees. On the premium what? 20 gone. So the maximum profit you can make is only 28. Yes or no? Correct? Yeah, right. The maximum loss the writer can suffer is also what? 28. That is, in other words, the maximum payoff to the holder is what? Break-even FSP, and the maximum payoff the loss to the writer is what? The break-even FSP. Because even the share trades at 0, what is your strike price? 30. Now, once again, think and tell me, share is trading at 0, your strike price is what? 30. Will you exercise a put a lapse? Exercise. Right the sell at 30, a share worth what? Nothing. How much the put gives you? 30. How much you pay as premium? 2. What is the profit? 20. Can I make 29 profit? For the share should be trading at -1. Yes or no? cannot be trading at what? -1. So the maximum profit the holder can make is what? Break-even FSP. The maximum loss the right can suffer is what? The break-even FSP. Respond, are you following on? That is why when you go for the valuation models, black shows and all, always put option value will be generally what? Lower than the call option value, because call risk covering is much more bigger than what? A risk covering for a put option. Everybody, are you following what I am saying? Now, can I proceed further? Write down. Next. Go to the put option, go to the third brand, FSP is what? Less than break-even FSP. Is correct? No. So I have dictated no, it is profit to the holder and loss to the writer. We can put it on right. The maximum profit to the holder is, the maximum profit to the holder is, Tungadappa, Sollu, the maximum to the holder is what? Break-even FSP. The maximum profit to the holder is break-even FSP. The maximum profit to the holder is break-even FSP. And maximum loss to the writer is, and the maximum loss to the writer is what? Break-even FSP. And the maximum loss to the writer is break-even FSP. And the maximum loss to the writer is break-even FSP. Maximum loss to the writer is break-even FSP. I hope you are all following or not? Now, point number 2 or 3. 3. How maximum profit is only, that's what to understand during revision, okay? How the maximum profit is only break-even FSP. How the maximum profit is only break-even FSP? Question mark. Right answer. In this problem, suppose the share, suppose the share is trading at 0 rupees. Suppose the share is trading at 0 rupees, come on. The holder will exercise the put option. The holder will exercise the put option at 30 rupees strike price. The holder will exercise put option at 30 rupees strike price and earn how much rupees? 28 rupees. And earn 28 rupees after paying 2 rupees premium. And earns 28 rupees after paying 2 rupees premium. After paying 2 rupees premium. He can never earn 29 rupees. He can never earn 29 rupees because for that he could never earn 29 rupees because for that the share should be trading at negative prices. Because for that the share should be trading at negative prices. The shares should be trading at negative prices. The shares should be trading at negative prices. Respond everybody. I have the clarity or not? Now, with this we complete the question number 4 and then question number 5. 4 and 5 speaks about what? Payoff of a holder and writer of a call option as well as what? Put option. All this diagram should be in the mind for easily interpreting any examination problem. Everybody, can I go to the next problem or not? No. Remaining to what? Simple problems. In fact, both are examination questions only. The very simple problem in basics. Take question number 6, please. Take question number 6. Can I start that? No. First of all, those who are understood up to this, raise your hand. Listening or not? Can I proceed? No. Jennifer is considering writing a 30-day option on Video Sonics Corporation Limited. Please. Jennifer is considering writing a 30-day option on Videosonics Corporation Limited, which is currently trading at rupees 60 per share. The exercise price will also be rupees 60 per share. Tell me, what is the first 60 per share, the spot price, and what is the next 60 per share, strike price? And the premium received on the option will be 3.75. Why Jennifer is receiving premium? Because she is a writer. Shall I proceed? Now, at what common share price will she make money? At what price will she begin to lose money? And what price she will lose 5 rupees and 10 rupees on each option that is written is a question that has been asked. Okay, now the question is silent regarding whether the option is call option or put option. So we should do the answer both for what? Call option as well as what? Put option. If Jennifer writes the call option, what happens? If she has written what? Put option, what happens? For both we should be giving the solution. Respond, yes or no? Can you start doing the problem together or not? No. Okay, please. Tell me. Full silence I want, please. Listen here. What is the strike price? 16 rupees. Suppose this is a call option. The holder is having a right to what? Buy. And how much rupees here? 16 rupees. But Jennifer is having what? Obligation to sell at 16 rupees if the holder exercises his right. Yes or no? Understand that who will decide? Jennifer will decide, her holder will decide. Always decision is made by what? Holder. Writer only obeys. You receive the premium, yes or no? So you have to only what? Obey what the holder says. Can I say? Now, my question is, when FSP is more than 60, holder exercises are less than 60, holder exercises are. You can be what? More than 60. When the FSB is what? More than 60 only, holder will begin to exercise. Yes or no? Next. What the premium? 3.75. What is the break-even spot price for the call option? Strike price plus what? Premium. What is strike price? 60. What is premium? 3.75. What the break in FSB? 63.75. All of you answer my question. When the FSP is 63.75 rupee, what is the profit to Jennifer? 0. Her profit is what? 0. If the FSP goes above 63.75, Jennifer will make profit or loss or loss. Now holder will what? Exercise and start earning money from the option. Yes or no? If the FSP is what? Less than 63.75, Jennifer will making what? Loss. Yes or no? No. Tell me. The question does not ask about the Jennifer start making what? Profit. Okay, sorry. The maximum profit Jennifer can make is what? The premium she is receiving. Are you following or not? No. The question is, at what FSP, common share price means the FSP, at what FSP will she make what? Will she make no money? That is, will she lose 5 rupees and also what? 10 rupees. Can we start doing the answer or not? No. Let's do it together now. Call writing. Please write call writing. Break even FSP is equal to, please. Break even FSP is equal to strike price plus premium. Call writing. Break even FSP is equal to strike price plus premium. Break even FSP is equal to strike price plus premium, which is equal to 60 plus 3.75. 60 plus 3.75. 60 plus 3.75. Can we proceed or not? Is equal to 63.75. Have the following columns. FSP, value of call, premium, payoff. FSP, value of call, premium, and then payoff. FSP, value of call, premium, payoff. Now, FSP is 63.75. FSP 63.75. Tell me what the holder will do, exercise or lapse? Indifferent. Yeah, who said indifferent? Yeah, wrong. Yeah. See, he has a right to buy at 60. A share worth what? 63.75. Please respond. Exercise or lapse or exercise. Holder will exercise and make a value of 3.75. Yes or no? Jennifer should sell the share or not? Yes. She will sell the share at how much rupees? 60. A share worth how much? 63.75. For the Jennifer, the value of the call is what? Minus 3.75. She is a right earner. The value is minus 3.75. For her, the premium is income or expense or income. She receives how much premium? 3.75. She receives a premium of 3.75. What is the payoff? The payoff is 0. The premium is 3.75. The payoff is 0. Next. Now, I want to have a payoff of minus 5. Payoff of what? Minus 5. Where I lose 5 rupees. For losing money, FSP should increase or decrease? Increase. It will go up by another 5 rupees. So no, FSP is what? 68.75. FSP is 68.75. 68.75. Answer, will the holder exercise or lapse? Exercise. He has a right to buy at what? 60. A share worth what? 68.75. Right, Jennifer has to sell at what? 60. A share worth 68.75. Will she make gain or loss? Loss. What the loss? Minus 8.75. For this, she is getting compensated through a premium of how much rupees? 3.75. A premium of 3.75. Tell me, what is the payoff for Jennifer? Minus 5. Payoff is minus 5. She wants to have minus 10 payoff. Does not want to have. She wants to know what will be happening for minus 10 payoff. What will be the FSB? 73.75. FSB 73.75. Tell me, what is the value of the call here? 30 minus 13.75. Right to buy at 30. A share worth what? Right to buy at 60. A share worth 73.75. Profit to hold at 13.75. Loss to write minus 13.75. What the premium received? 3.75. What the payoff? Minus 10. The payoff is minus 10. Now, please read the question. At what common price will she make money? At what price will she begin to lose money? That should be answered or not? Write down. Next. Jennifer will make money. You have to think and tell me simple issues. Class of Jennifer should what? Will make money. Jennifer will make money when. Jennifer will make money when. Sollu answer. I want everybody to answer. Will make when you want when what? FSP less than 63.75. Jennifer will make money when FSP less than 63.75. Jennifer will make money when FSP less than 63.75. FSP less than 63.75. And will lose money. And will lose money when FSP crosses. And will lose money when FSP crosses 63.75. And will lose money when FSP crosses 63.75. When FSP crosses 63.75. Remaining two questions answered. At what price will lose 5 rupees? Yeah, 68.75. 10 rupees, 73.75. That's there in the slide itself. Everybody yes or no? No. So now if Jennifer is writing a call, this is the answer. Yes or no? She can also be a put writer. The question is silent. Yes or no? No. Right now. Next, put writing. Put writing. Put writing. I forgot. What a break in FSP? Strike price minus premium. Write out. Break even FSP is equal to strike price minus premium. Break even FSP is equal to strike price minus premium, which is equal to 60 minus 3.75. 60 minus 3.75 is equal to 56.25. 60 minus 3.75 is equal to 56.25. Now, tell me, when a holder will make profit in a put option, when the FSP is higher, lower? When the FSP drops only, he will be making what? A profit. He is a bearish person, yes or no? No. That means, when the FSP is less than what? 56.25, the holder will start making payoff, and the right will be having what? A negative payoff. Innappa, right or not? Can I proceed further? Now, let's go for the solution. FSP, VP, premium, payoff. FSP, value of food, premium, and then payoff. Can I proceed or not? No. FSP 56.25. FSP 56.25. Answer my question. Will the holder exercise or will he lapse or exercise? He has a right to sell at how much to pay? 60 rupees. A share worth what? 56.25. He'll exercise or not? Yes. He'll make a profit of 3.75. As a right, I should buy it how much? 60. A share worth just only what? 56.25. My loss is minus 3.75. Yes or no? Minus 3.75. For which how much I received a premium? 3.75. The payoff is 0. Answer. For me to have minus 5 payoff, it should be more than 56, less than 56, less than 56. How much less? 5 rupees less. So what is the FSP? 51.25. FSP is 51.25. Will the holder exercise or lapse? Exercise. He has a right to sell at 60. He has shared what? 51.25. Tell me the profit to the holder. 8.75. The writer makes a loss of minus 8.75. 8.75 is going to be minus 8.75. What is the premium? 3.75 received. What the loss to the writer? Minus 5. The loss to the writer is minus 5. Now, she wants to have a minus 10 loss. What should be the FSP? 46.25. 46.25. Yes or no? Now, will the holder exercise or lapse? Exercise. He has a right to sell at 60. He has share worth what? 46.25. What is the loss? Profit for the holder 13.75. Loss for the writer is minus 13.75. What the premium? 3.75. The payoff is minus 10. Premium 3.75, payoff is minus 10. Is the answer for this particular question. Yes or no? Now, write down. Jennifer will lose money. Jennifer will lose money. Tell me when Jennifer will lose money? When FSP less than 56.25. Jennifer will lose money when FSP less than 56.25. Jennifer will lose money when FSP less than 56.25. And will gain money and will make money when FSP is above 56.25. And will make money when FSP is above 56.25. And will make money when FSP is above 56.25. Everybody, are you following or not? Now, with this we have completed question number 6. 7th question I'll come and do later after some binomial model etc. Very basic sum only, but I don't want to do it at this particular stage. 7th sum will come back and do it later. Very simple problem only. Can I proceed or not? Now, with this, please, we have completed one slot in this chapter called as derivatives. That is called as what? Basics in options. In the options that we have completed an area called as what? Basics in options. Can we go to the next stage or not? Now, see. Till now, what you have learnt is terminology is used in call option as well as what? Put option. How the profit is made by the holder as well as writer. Just we had an introduction or entry into this particular chapter called as options, which we discuss in the basics in options. Okay. Now, let us first see the agenda for this chapter. We write that as a learning objectives first, so that we'll be knowing what we are doing. It's a very long chapter and big chapter. We should be understanding the stages which we have completed every time the chapter gets completed. Okay. Others will be lost, something lost into a forest now, will be lost into it. So you'll be knowing the stages in this chapter, options. I am not saying derivative, I am saying only options. You are having what? Such a big chapter, around 40 plus sums. We are having in what? The workbook. So now let us see the stages we are going to discuss, and then we can just start discussing one by one. Write down learning objectives. I did not dictate this learning objectives earlier because I want you to get used to the various terminologies. Now we can start discussing of the learning objectives. Now, write down learning objectives. Underline that. Point number 1.